5 things that delay deals. I'm Arthur Petropoulos, managing partner here at Hillview Partners. We're a middle market, low middle market, M&A and capital advisory firm helping companies generating $1 million to $10 million in pre-tax profit exit their businesses and secure capital on optimal terms, on an optimal timeline, optimally discreet, with the least amount of friction or distraction. Prior to starting Hillview Partners, I spent the better part of a decade in New York working in investment banking, private equity, and corporate development. In that timeline, was involved with over $1 billion worth of transactions on that side prior to Hillview Partners. And what I can say is that in all of the hundreds of deals that I was involved with, whether it was leading the deals, being a part of it back in the analyst days, whatever role I was playing, it was a front row seat to the good, the bad, and the ugly. I saw deals that worked out phenomenally well. I saw deals that worked out terribly. And in my career, I've always tried to extract what is the differentiator. If 90% of the things that happen are the same within any deal, yet the outcomes are materially different, what is it that drives the outcome from good to bad? What moves that needle in that direction? And really, susses out to these 5 main items, some more attributable to sellers, some more attributable to buyers, but in any case, it's the responsibility of the representatives to avoid these at all costs, to spot them, to put out all fires, and to really quelch out any of these types of issues. First of these is bad information. If a company selling itself does not represent things accurately, or if the party that's looking to buy something or provide capital does not represent itself accurately, then everybody's working off a foundation that's sloppy and slipshod. And therefore, if you think of building a deal as building a tower, if the foundation is lousy, then there's going to be a certain height of the deal. There's going to be a certain point of the deal where the fundamental information causes a crack and deals can fall apart. And therefore, that does not mean that one should not zealously advocate, for instance, a normalized or adjusted EBITDA that bakes in all of the one-offs and nuances. It just needs to be clear. It needs to be crystallized. For instance, with EBITDA normalization, we always provide a bridge. And so we say, okay, here are the numbers that are on the P&L that are going to tie back to the general ledger. Here are the adjustments that we made based on the different variables of why certain things are non-recurring, one-off, or just traditional EBITDA add-backs. And here is the adjusted and normalized figures. Now we can negotiate why one were to give credit or believe any of these adjustments more than others. However, the information is going to be good. It's going to be very clear how it was developed, and you'd be surprised at how many times that's not the case. Secondly, are bad processes. Oftentimes people think the deal business is like a romantic comedy. 2 parties fall in love and everything just works out wonderful. Not the case. It could be the best fit of parties. However, if neither party has a very clear, precise path of how things go from discussion to offers, offers to agreement, agreement to closing, then things just don't happen. Things sputter out. Things get deal fatigue. Time kills all deals. Things happen. And therefore, it's incredibly important for both parties to define their processes right at the outset such that if there's any disagreement on any components of it, they can be agreed upon. And so after bad information and bad processes, third thing that will delay a closing or kill a deal is bad communication. So even if there's a path that's been painted, even if there's good information, things still need to be communicated. Not everybody's going to agree on everything. There has to be tough conversations. There has to be things negotiated, and things have to be pushed forward. The can can't get kicked down the road. And so a direct yet diplomatic means of communication from both parties to one another to say, this is an issue, this is not an issue. For this issue, let's talk about how we resolve it. And then we quickly get to play or pass. We quickly get to, is there a resolution or is there not? Point being is sometimes there can be a tendency in deals to just focus on the things that there is no disagreement about. Just focus on the things are not going to be issues. And what that ultimately does is that it pushes the gating issues or the main things that could make or break a deal way down the road. And again, you'll see the recurring theme in any deal is that let's pull all of the difficult things forward. Let's get through those things quickly, because if we can get through that together and have an agreement on the high-level terms, on the structure, on the path, then it's just a matter of execution. So take away the do we want to do this risk and keep the risk and minimize the risk of purely just execution, getting the things done. And it meaningfully enhances the probability of getting to the closing. And if it's not going to be a deal that's going to be done, you want to get that sorted out long before there's offers ever made or agreed to. And so number 4, bad responsiveness. And so again, if you have good information, if you have good processes, if you have good communication in the sense that people are saying the right things to each other, but there's just not a responsiveness, basically it's playing all of the right notes in the wrong timing in a symphony. There's a momentum to deals. Just like in any business, there is a traction that is gained in the beginning, and responsiveness and good communication and the right information going back and forth builds a momentum, because there are going to be certain points in the deal, and we've discussed it in other videos, whether it's the negotiating of the LOI, whether it's the quality of earnings and diligence, whether it's the finalization of the definitive documentation, purchase and sale agreement, if you will, or the loan documents. There's going to be certain things that there's some friction, where there's a necessary back and forth, and you need enough momentum running into those things to push through them. And so the responsiveness is, we always say, the easiest way to build momentum in a deal is be responsive. Instead of waiting a day to get back to someone, get back to them in 2 hours. Instead of waiting a week to get someone the document, get it back to them in 48 hours. If the counterparty feels that you're going to respond to their information without them having to hound you, if you're going to get what they need to them in timely manner, it builds a lot of goodwill and momentum, so that when you do hit those points of a deal where there's either something contentious, an issue that needs to be resolved, you'll have a lot more willingness to try to reach a compromise. And number 5, for lack of a more eloquent phrasing, is bad people. You can have all of the right things in a deal together, but if you're dealing with people that don't have integrity, if you're dealing with people that aren't honest, and if you're dealing with people that are looking to pull the wool over someone's eyes, it's not going to be a good outcome. We've been doing this now for 15 plus years, and the deal business, just like any other business, is a pretty small world. And everybody knows everybody, and people know who are the honest actors, and people know who are the dishonest actors. And it doesn't mean that just because certain things don't work out that someone's dishonest. That's like in any business. There's some things that work out perfect, there's some things that do not. Who tries to sneak things by? Who tries to do underhanded things? Who tries to retrade situations? Those things are fairly well known. That's why in any business, whether it's deals, donuts, or doorknobs, you really should have a Sherpa or someone working with you that knows the lay of the land, because you can do all of the right things the right way, but if you're not dealing with the right people and the right integrity of people, it's not going to reach a good outcome. And even if it does reach a deal that happens, the post-transaction considerations can be just as painful, just as bad, and you want to avoid that. We'll leave this video on one note. Let's quickly recap the 5 things that can delay or kill a deal. Bad information, bad processes, bad communication, bad responsiveness, and bad people. I want to end this on one note. The one thing we did not point to is bad luck. The objective of the process of selling your business, of securing capital, of doing it intelligently with the right information, with the right people, is to remove the element of luck from the process. We always say we want asymmetric risk. We want no downside, meaningful upside. And that's the way we run the process. And people think that the outcome is going to fall from the sky, or that the probability, if you will, of a good or bad situation is purely luck, depending on what the market has to offer. And that's just not true. So yes, there are going to be some elements you need to work within. However, the vast majority of the outputs are predicated on the inputs, and the inputs are controllable by the parties. And so we remove luck from the situation by having the right information, by communicating it the right way, in the right manner, to the right parties through the right process. And so bad luck, just the same as preparing the right way and approaching it the right way, avoids these other 5 issues. We also want to take luck out of the situation as well. And so we'll take God's blessings wherever He'll give them to us, but we're not going to count on luck, and hope is not a strategy when it comes to business deals. Hope the week's finishing up well for everyone. Keep pushing forward. God bless. We'll see everyone next time.